Did you know that you might already qualify for investments the average person will never see? So why is your money still doing average things? There's a secret door in the financial world. And if you're a high-earning tech employee, you may already have the key, but no one ever told you how to unlock it. Stick around because in the next few minutes, I'm going to show you exactly what this means, how to verify if you qualify, and what investment opportunities you've been locked out of until now. Hello, I'm Christopher Nelson. I have built and run my own microfamily office. Today, you're going to learn what it means to be an accredited investor and how this gives you access to exclusive, non-public investment opportunities. Now, here's what most people don't realize. High-earning technology employees usually qualify as accredited investors without even knowing it. Your income, your bonuses, your RSUs often meet these requirements. Now, it's important to understand that these options come with higher risk, but they also offer the potential for upside and income, things that can get you to financial independence. So today, we're going to cover off on the fundamentals, who and what qualifies as an accredited investor, how to verify your status, what this actually means for your wealth building, and then also what investment types become available to you. I want to wrap it up with some of the common misconceptions and real risks that you have to know. Ultimately, my goal is simple: give you a clear, fact-based understanding of your accredited status so that you can make an informed decision about your financial future. Let's get started. An accredited investor is defined by the SEC based on three main categories: income, net worth, or professional qualifications. And again, these are or requirements. You need to meet one of them, not all of them. So income, if you report $200,000 or more on your W-2 individually, or you and your spouse report more than 300,000 combined for the past 2 years, then you will qualify as an accredited investor. That is the income path. For the net worth path, you need $1 million or more in assets, excluding your primary residence. So if you're sitting on $1 million house and 800K in other assets, you don't qualify, not through net worth anyway. But if you have that million in investments, 401k, a brokerage account, sitting in cash or CDs, you are in. You qualify based on net worth. Then there's the professional path. So this is where it gets interesting. Individuals who pass the Series 7, Series 65, or Series 82 exams can now qualify as accredited investors, even if they don't meet the traditional income or net worth thresholds. So here's what's fascinating for technology employees specifically. Many of you hit these thresholds through high salaries and bonuses, through IPOs, acquisition, and equity compensation that's building over time, and you don't even realize it. But this is where it gets better. You also can have an LLC, a micro-family office, considered an accredited investor if its total assets are over 5 million, or if every equity owner who's in there is individually accredited. This is just important to note, especially as you're running a micro-family office. But if you take a step back and you think about it, you're a senior engineer at a FANG company pulling in $250,000 a year base, plus you also have equity, RSUs, and you've been there for 3 years, I'm sure that you are already accredited and you've been that way for a while. But just remember that qualifying is just the beginning. So it's the why, why you should qualify and why you have the status that actually matter. Accredited status is not just a label. It is a legal gateway to investment opportunities that Wall Street doesn't have access to and generally are not advertised in public. But here's the key. Only accredited investors are allowed to trade securities that are not registered with the Securities and Exchange Commission. Let me say that again. Only accredited investors are allowed to trade securities that are outside the purview of the SEC. The key thing to note is this includes these high yield, high income private placements meaning it's private money, hedge funds, and also private equity real estate. The key thing to note is that the SEC limits access to protect inexperienced investors who don't have a lot of money, and they want to protect them from these high-risk products. But because you have a higher income, they want to allow you exposure if you're accredited. And this is what you're missing out on, right? These are the types of investments that are going to allow you to truly build wealth. I'm talking about private equity, where you can directly invest in operating companies that are not traded on the public market. I'm talking everything from service companies to very large software companies as well. Think about buying stakes in the next unicorn, but before it goes public. The other opportunity is hedge funds and a lot of these advanced financial products. These are investing in high yield, unregistered securities that are using different strategies like short selling and derivatives. These are much higher risk, but also higher potential returns. And then finally, I'm talking commercial real estate funds and syndications, where you pool your money with other accredited investors to buy large commercial properties, multifamily, industrial warehouses, you name it. And the key thing here is 6 to 10% cash on cash returns that are also tax protected. This is where the real rocket fuel is to financial independence. And here's the kicker. America's wealthiest families invest 50% of their assets in alternative investments just like these. Meanwhile, most technology employees are sitting in index funds and growth stocks, wondering why their wealth is not unlocking the lifestyle that they truly want. When I went through my IPO in 2012, 90% of my wealth was tied to a single stock. I was riding the emotional roller coaster of the market ups and downs every single day. But once I understood accredited investing, I was able to diversify into private equity, real estate that now generates the consistent income that replaces my paycheck. And that's regardless of what Tesla or Apple is doing on any given day. These investments typically have large minimums. It's important that you're aware of that. I'm talking 25,000, 50,000, or 100,000 to start. They're long-term holds with limited liquidity, but that's also exactly why they can offer returns that the public markets can't match. They don't have to fight with liquidity. They can keep it in these investments long-term. But here's the thing. Once you're accredited, the question isn't if you can invest, but how to prove it and actually get access. Access to accredited investments requires documented proof of eligibility. And here's what most people get wrong. It's not your job to verify yourself. It's the investment company's responsibility. So there are two main rules that govern this. Rule 506B, 506 Bravo, that allows self-certification. You basically check a box saying, yep, I'm accredited, and that's it. Then there's rule 506C, or Charlie. This requires a third-party verification. The issuer or the sponsor must verify your status through documentation that you submit to a third party. So for verification, you're typically going to need a couple of things. Tax returns for the past 2 years, especially around the income requirement. It may also require recent pay stubs. It could also require some bank statements if you're doing net worth, bank, brokerage statements. Or one of the easiest ways is to have a CPA or attorney who reviews your private documents. Just submit a verification letter. Here's my pro tip. Easiest way to prove you're accredited: get a letter from your accountant, attorney, or other qualified professional, have them review all your financials, and provide a simple verification letter. So, for example, of all the offerings I work with operate under Rule 506C, which means they must perform their own due diligence to determine your status before they can accept your investment. Here's the bottom line. The company offering you the investment must verify your status. Your job is to simply provide the correct documentation that they correct. But hold on, before you get excited, now that you have the keys, I want to talk about what could go wrong. Let me be completely clear about something. accreditation opened doors to more and riskier investments. Access alone does not guarantee profit or any type of success. Here are the real risks that you need to understand. Higher risk, less protection. These investments have fewer regulatory requirements. They're outside the purview of the SEC. What this means to you is that if something goes wrong, many times you may have less legal recourse than with public securities. Then there's liquidity risk. Many alternative investments lock up your money for years. You can't just sell and get out of it like that you can with stocks. The other status can be lost. Like you can lose accredited investor status if you're dependent on an income status and then you lose your job and your income drops off, or if your net worth falls below the threshold. This has happened to many people during the 2008 financial crisis and sometimes during 2020. The biggest misconception is that accredited investors have some secret formula to guaranteed returns. They do not. What they have is access to a broader range of asset classes, and some perform better and some perform worse. Now, here's where it gets really interesting. Here's where you may not know. There's actually a level above the accredited investor called the qualified purchaser. A qualified purchaser is somebody with at least 5 million in investable assets, not net worth, investable assets. This opens up access to even more exclusive investment opportunities. When I structured my microfamily office, understanding these different investor classifications was crucial. It helped me to plan not just for where I was, but where I want to be in 5 to 10 years. Meaning I'm building a business that is going to have these different qualifications embedded in it and grow with that. This is why having a clear strategy and planning is critical for accredited investors. You want to make sure that you have the systems and the structure to ensure that your wealth doesn't devalue over time and then you're not in a drawdown situation. Here is what separates successful accredited investors from those who just have access. Successful accredited investors only invest in things that they understand. They're not looking for the most complicated investment. They're looking for simple, straightforward, boring ways to make high yield and money. They also have clear allocation strategies. This is risk management. They're only going to put 1%, 3%, or 5% of their net worth into a single investment, with 1% being the norm and 5% being very, very rare. They're also going to understand what is their own risk tolerance. If they don't understand or if they don't have enough education, they're going to, again, slowly build positions over time and not push all in. Ultimately, this is a complete strategy of planning for long-term wealth preservation and divesting your portfolio as you grow as an investor and a money manager. And when you build systems around your investments and you partner with people who truly understand these things, that is what's going to accelerate your learning. When I transitioned from being a high-earning tech employee to running my own portfolio and microfamily office, accredited status wasn't the end goal. It was really the beginning of a new marathon, a beginning of me building a system, learning a technique that could generate income and unlock the lifestyle from my wealth. So here's what you need to do right now. Number one, determine if you qualify. Look at your W-2, look at your RSUs, calculate your net worth and your income, excluding your home, and check to see if you have qualifying certifications. Step two, if you qualify, don't just rush into anything. Start by educating yourself on the types of investments available and which ones align with your goals. Number three, build the infrastructure. Just like you wouldn't deploy code without a proper architecture, don't make an accredited investment without the proper systems in place. And also some type of a peer review, somebody to look over your shoulder and help you know if you're making the right decision or not. This is exactly why I developed the Wealth Ops framework, because it's designed to help tech professionals like you transition from money makers to money managers, treating your portfolio just like a scalable business. In my microfamily office approach, accredited investing is one component, just one, of a comprehensive wealth management system. It starts with architecture. You need to understand your why and where that's leading you to invest. What are the types of investments you want to make? You need to actually build the entities that go with that and have an operational system month over month, quarter over quarter that supports it. All of this combined leads to a great system that works together and helps you build wealth slowly over time. And if you want to dive deeper into building your microfamily office, I would recommend that you attend the Wealth Ops Way. That's a live class that we feature every single month so that you can learn how to architect and set the direction of your microfamily office. Remember, being accredited doesn't make you rich, but knowing how to use that access strategically, that's where real wealth building starts.